Despite the uncertain state of the economy in 2023, characterized by high inflation, rising interest rates by the Federal Reserve, and a struggling stock market over the past year, there are notable investors who have been taking advantage of this situation. Warren Buffett, for instance, has been actively investing in the market, despite facing criticism for being relatively inactive in recent years. This trend of investing during economic downturns have proven successful in the past, with super investors like Buffett buying during previous crashes in 2020, 2008, and 2001. Manish Pabrai, a well-known colleague of Buffett and close friend of Charlie Munger, has recently shared 3 fundamental rules for successful investing, especially relevant in times of high inflation and economic weakness. One of these rules is to identify companies with a durable competitive advantage. It's a crucial point to understand that being the first in the market may be advantageous initially, but it doesn't guarantee long-term success. For instance, Snapchat, Atari, and Motorola were all pioneers in their respective industries but ultimately faced setbacks. Simply being a first mover is not enough. What truly matters is the intrinsic character of a business that sets it apart from competitors in a lasting way. This unique quality is often referred to as the moat, and it's something that cannot be easily replicated by other companies, no matter how hard they try. Manish Pabrai discusses this particular type of moat in the following clip, highlighting its importance in today's business landscape. Hey, welcome to Stock Market Mate. Today we'll talk about how to use the recession to get rich and make money online 2023. But before we get into it, do subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Repeatedly, we observe that the most potent moats in business are often related to branding. As Manish Pabrai points out, despite objective evidence showing that the taste of Pepsi may be more popular than Coke without its labels, when the labels are on, Coke indisputably holds the top spot as the world's favorite beverage. In fact, businesses with strong brand recognition, though it may seem counterintuitive, tend to have the most resilient moats and can be excellent investments during challenging economic times. Consider this. Having a moat means that customers keep coming back to your product or service and are less likely to switch to alternatives, even when facing financial constraints. For example, Ferrari is a brand that maintains consistently high demand despite the availability of cheaper or more advanced cars. Similarly, luxury brands like Louis Vuitton may not necessarily offer inherently higher quality products, but customers are drawn to the brand, design, logo, and what it represents. However, it's important to note that no moat is eternal. It is essential to monitor and ensure that the moat remains enduring over time, even for well-established brands. As an investor, it's crucial to continually monitor the strength of a company's moat, even for a formidable company like Apple that has a significant brand moat and switching moat. So how can we identify a moat? One approach, as suggested by Phil Town, is to examine the long-term track record of key financial metrics such as revenue, earnings per share, free cash flow, and equity, and assess if they have been consistently growing at a rate of over 10% per year. In the case of Apple, their financials generally appear positive, although equity may be affected by share purchases. Their interrupted growth over a prolonged period may indicate the presence of a moat. On the other hand, declining sales, shrinking margins, or negative media sentiment such as store closures could be signs that a moat is being breached. Identifying a business with a moat is a critical first lesson in successful value investing during challenging economic times. However, let's now shift our focus to another key element that Manish discusses next. The importance of having a long-term outlook applies not only to the companies we invest in, but also to us as investors. As value investors who manage our own money, our biggest advantage is that we are not bound by short-term pressures. Unlike active funds on Wall Street that are fixated on making quick returns quarter to quarter, we have the luxury of patience. Value investing, as Manish emphasizes, is a game of waiting and requires a long-term perspective. We seek out great companies during favorable times and then simply wait. It may take 1 year, 3 years, or even 5 years for the crisis to pass and the recovery to kick in, but we can afford to wait. It may be boring and it may require relative inaction, but when we exercise patience and focus on holding these businesses for the long term, that's when we can ultimately profit. Having a long-term outlook is a powerful advantage that allows us to stay disciplined and make informed investment decisions without succumbing to short-term market fluctuations. It's remarkable how the S&P 500 index consistently outperforms over 90% of active fund managers in the long run. This serves as a compelling example of how a short-term mindset can hinder one's success as an investor. As value investors, we prioritize staying invested in businesses with proven moats and holding them for an extended period of time. By following these principles, a significant portion of the long-term risk of loss can be mitigated, even if we make mistakes in our valuation. It underscores the importance of adopting a patient, long-term perspective in our investment approach to achieve better outcomes. The greatest advantage of a long-term investment strategy is that even if you accidentally buy a high-quality business at a relatively higher price, it can still be worth significantly more in 10 to 15 years. This doesn't mean the valuation is irrelevant, but it's reassuring to know that investing in a high-quality business at a fair price, rather than just a bargain price, can still yield excellent returns over the long haul. This approach has been successfully employed by Warren Buffett with companies like Coca-Cola and Apple, among others. However, it's crucial to note, as Monish emphasizes, that there is one more critical point to remember once you have identified a potential big winner. Economic downturns can have severe consequences on individuals and communities, including job losses, financial hardships, and negative impacts on businesses and the economy as a whole. It's important to approach investing and financial decisions with a responsible and ethical mindset. Here are some general tips for navigating economic challenges. Number 1. Diversify your investments. Diversifying your investments across different asset classes, sectors, and geographies can help mitigate risks during economic downturns. Avoid putting all your eggs in one basket, and consider seeking professional advice from a qualified financial advisor. Number 2. Focus on long-term goals. Economic downturns are often temporary, and markets tend to recover over the long term. Avoid making impulsive decisions based on short-term market fluctuations, and stay focused on your long-term financial goals. Number 3. Be prudent with spending and budgeting. During an economic downturn, it's important to review your spending habits and create a budget to ensure you're living within your means. Cut unnecessary expenses and prioritize saving and building an emergency fund for unexpected financial challenges. Number 4. Look for opportunities wisely. While economic downturns may present some investment opportunities, be cautious and do thorough research before making any investment decisions. Avoid taking unnecessary risks and make informed decisions based on your financial situation and risk tolerance. Number 5. Seek professional advice. If you are uncertain about your financial decisions during an economic downturn, consider seeking guidance from a qualified financial advisor who can provide personalized advice based on your individual circumstances. Remember, the goal should be responsible and ethical financial management, rather than seeking to take advantage of others during challenging economic times. It's important to prioritize long-term financial stability and consider the potential impacts on others in the broader economy. The final piece of the puzzle is to hold on to a business with a wide moat, which you've committed to owning for the long term and purchased at a fair price. Unless there are fundamental changes, it's better to keep holding on, even if it becomes slightly overpriced. Let the business do what you initially anticipated over a decade or two, allowing it to compound like Amazon, Google, or Tencent. This is the key to achieving significant returns, resisting the urge to cut the flowers, or winners, and watering the weeds, or the underperformers. Value investors follow the opposite approach, watering the flowers and cutting the weeds. This is the not-so-secret formula to profit during tough economic times. Number 1. Identify companies with distinctive intrinsic characteristics that set them apart. Number 2. Plan to hold them for the long term. Number 3. Avoid panicking and selling them prematurely before they have had the chance to compound returns for you. In summary, these are 3 lessons for Monish to come out on top when investing during an economic crisis, with the overarching reminder to always stay rational. Well, that's about it for today's video. We hope you enjoyed this video about how to use the 2023 recession to get rich and make money online, which can be followed and assessed by almost anyone to be a successful investor. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you at the next one.
If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!